Well, it's simple. If the pulse of the economy goes down, then the policymakers, like doctors, rush to the patient and inject it with a whole lot of stimulation. So what they did is they wrote out a bunch of checks, and they're writing out a lot of checks, which are about 7 times, 5 to 7 times the size of the whole. And they got that money out. And what that did was, of course, the government doesn't have money. They can't print money, so they have to borrow that money. But the Federal Reserve can print money. And so the same thing that is happening like on March 5th, 1933, is the same thing now in terms of that big stimulation. So the way it works is real interest rates are so bad, money's so cheap, and it's so abundant that it changes a lot of financial assets. And it causes those financial asset prices to rise. And when they rise, future expected returns go down to start to approach those of bonds and the risk-free return. And so that's what we've gone through. So you see it domestically, you see it also in the currency, in the dollar, you see it in other assets, gold, Bitcoin, and so on. So the world has got a lot of liquidity. And now we're in a spot where we're going to have the supply-demand question. The big question is the supply-demand question, because we're going to have to sell a lot of debt. And then the question is how that goes. Will the demand be there, or will the Fed have to monetize more? That's the dynamic. We have a big wealth gap. We have a big opportunity gap. We have big gaps that are issues. We see it here. I work, my wife, particularly in the state of Connecticut, works with disengaged and disconnected students, high school students in poor neighborhoods and so on. And you see their conditions and what the budgets are. There are a lot of needs. So I'm not saying the needs are not there. I'm saying just the way the machine works, the reality of it is you're making this big supply demand move, but that it's not like it doesn't have risks and costs associated with it. So from the market's point of view, it's a real big deal. Because like debt, at the end of the day, it's going to be one way or another. It's either going to be when somebody borrows and you're using that debt, is that going to produce productivity so that in hard money terms that money can be paid back in a way where, okay, it paid off in a productivity increasing way? Or is that not going to be paid off? And somebody's always going to pay, but it's going to be the bondholder, it's going to be the cash holder who is going to pay if that doesn't come back with real productivity. And right now, it was an emergency situation with COVID mixed with a political situation to disperse a lot of money. And that's what we have. But it's not ending there, because that's the new policy. There are two types of inflation. Okay, let me just clarify. There's supply-demand inflation, like if demand is pressing up against capacity to produce things, and maybe that's labor, maybe that's capacity constraints and so on and so forth, prices rise because of that. And then there's monetary inflation. And monetary inflation is because the currency and the value of money goes down. And so you can see, like in the 1970s, stagflation. You could see inflation is not coming from the first of those types of inflation. It is coming from the second of those types of inflation. And the way that would occur is because people don't want to own bonds. To me, it's pretty crazy to want to own cash or bonds. Okay. But if you have that movement out of like that type of financial assets to other assets, which we are seeing, then that has the effect first of causing financial inflation. In other words, an investor shifts it to another investment and they go up in value. And then that wealth effect has an effect on those items that those people who acquire the money want to spend on. So maybe it's on penthouses or maybe it's on something else, but it depends how that's spent. I'm more worried about the monetary inflation, which would look something like a currency defense. It means that what happens is as money, let's say people don't like bonds, and then they start to sell bonds. And bonds then go down in value because they have a capital loss. And they don't offer anything in interest rates, negative real interest rates and so on. They don't like that. Then the Federal Reserve or other central banks are faced with the choice of either rates rise, and that is bad for financial asset prices and it's bad for the economy, or they make the purchases. They make money and they make the purchases of that. And that then produces more of a monetary inflation. So it's the second that I'm more concerned with. But the supply demand of debt will be, I think, the big driving influence. And I want to emphasize this because so many people say they look at this stock or they look at this. But what you saw was the V bottom in all markets and so on. And that was due to debt and money dynamic happening. So that's the biggest dynamic to pay attention to. I think it was April 8th or 9th. The exact same action was taken basically almost as happened on August 15th, 1971, which was also the exact same action which was taken on March 5th, 1933. In other words, the big jolt, the separation in terms of that value of money, that dynamic. And that is the new paradigm. What's happened is that, like these cycles go, a lot of new ideas, new technologies, new things come along, and they make fabulous revolutions and they grow things. And that's great. But there's a tendency of investors to extrapolate the past and not pay too much attention to price. And when that happens, you start to emerge as somewhat of a bubble. By our measures, the bubble is not as what it was in 2000 and not what it was in 1929, but it's kind of like halfway there if I look at the types of qualities. And so what that means from a value point of view, if you're calculating, what can I realistically expect? It's expected returns shrink relative to the others. However, the kind of the meat and potatoes type of companies didn't benefit as much from those, and they're fairly stable and so on. And so that's why you're starting to see that kind of rotation. Now that can change. It can come and go in these phases, like when people get stimulus checks and then, they might be hot on, the exciting things and they run up again and so on. And of course, there's Bitcoin and other things that are going on. However, the big thing is plenty of liquidity and ridiculously low interest rates. Now, you ask about the 1.6%. I think we have been in a 40-year bull market in bonds. So now you look at that 1.6%, that's a negative 1% about real, okay? So you're guaranteed. And you ask yourself, if you're going to hold a bond, any investment, the only purpose of an investment is so you can sell it to buy something you want. And so when you look at what is the length of time it's going to take me to get my money back, if I give an investment nowadays in the United States, I'm going to have to wait about 50 years to give back the buying power, and then I'll start earning money. If I'm in other countries, Europe and Japan, I will have less. And if I measured in all those countries in real terms, I'm going to have less money. So basically what that means is if I just bought anything that didn't depreciate in real terms, if it just matched inflation, I'd be better off than to have those things. Now, I don't think those rates will only stay down there, I think, if the Federal Reserve does what it did like in the 1930s in the war period, which is to put a cap on rates, to make short-term interest rates low in relationship to the cap. Like back in the 30s and the war years, they made 1% was the short-term interest rate and 2.5% was the bond yield. So it was profitable to buy those bonds, funding it with 1%, and you got 2.5%. That could put a lid on it. But because those two assets, cash and bonds, were such bad investments relative to other things, there was the movement to those other things still, and then the government outlawed them. I mean, things like gold, they outlawed gold. That's why also outlawing Bitcoin is, a good probability. And that they also established foreign exchange controls because they had money to go elsewhere. The big risk is this an environment that's hospitable for capitalism and capitalists? That affects capital flows a lot. And it's not just affecting American capital flows. Americans think it's just Americans. No. Foreigners own way more bonds, American bonds, than Americans own. So just the whole notion of where to go, where it's safe market for capitalism and capitalists has an effect on capital flows. So those are the mechanics.